Welcome back to the gold standard. This week, gold slipped about 2.7% and silver nearly 5%, yet big banks still have 2026 targets in the mid-5,000s per ounce.
Which sounds wild if you just watched your portfolio bleed red. Here's why this matters. Short-term pain can live next to those huge upside calls without anyone being crazy.
Think about it this way. Traders are living in the next 48 hours. Allocators are living in the next 8 years, and their models are not asking the same questions.
Right. Now let's consider what's layered on top of that. Iran headlines and strong U.S. jobs data pushing gold in directions that didn't feel like the classic safe haven script.
Exactly. The important thing to understand is that panic phase selling and longer crisis behavior can look opposite on a chart, even when the story is consistent.
So today we're going to test that safe haven label, walk through who's actually buying and selling, and then link it to central bank flows, GLD versus SIL, and those big streaming deals like BHP and Wheaton.
In the end, you should have a clearer framework for sizing gold, silver, platinum, and palladium positions in this volatile 2026 tape.
Right. And we're keeping it practical. When to pay attention to 1 month of flow data, when to ignore it, and how to read those bank forecasts without getting whipsawed.
All right, let us start with the big one. Gold down 2.7% on the week. Now let's consider what that really says about 2026 targets.
Stay with us. Segment 1, Gold Price Action and Forecasts, starts right now.
Gold just had another rough stretch. Spot prices slid about 2.7% this week, while silver dropped close to 5% as the dollar firmed and real yields pushed higher.
Right, so here's the core tension. Both metals are taking real hits in the short term, but simultaneously, big banks are still talking about gold blasting towards the mid-5,000s per ounce in 2026. That gap is enormous.
Exactly. Think about it this way. We are trading thousands of dollars below some of those published targets. Goldman Sachs, JP Morgan, ANZ, HSBC, Heraeus, and Indexbox, they're all in that 5,400 to 5,800 neighborhood for the next year or so.
So let's think about this carefully. How do we reconcile a down week with those almost eye-watering forecasts? Are these numbers actually grounded in something concrete, or are they just headline bait?
The important thing to understand is that each house has a framework. Take something like a 5,800 call. Under the hood, you usually see 3 pillars. Slower inflation but still above target, a Federal Reserve that cuts or at least stops hiking, and some kind of stress in growth or credit that keeps investors hungry for hedges.
So, a kind of Goldilocks for gold. The important thing to understand is not runaway inflation, but enough price pressure that real rates do not stay high, plus a Fed that's easing or signaling cuts, so cash and bonds lose some appeal.
Exactly. Now let's consider positioning. Many of those forecasts assume investors increase allocations through ETFs, futures, and options, and that central banks keep adding to reserves instead of selling. That's where the flows come from to support those targets.
Here's why this matters, though. When we zoom in on a single week like this, the market is reacting to something fundamentally different. Stronger U.S. data, higher Treasury yields, a firmer dollar, all of that pulls capital away from bullion fast.
Right. In that environment, gold starts to trade less like a safe haven and more like a long-duration asset. Higher real yields raise the opportunity cost of holding metal that doesn't pay interest, so traders cut exposure and you see that 2 to 3% air pocket appear.
Let me press you on this. How does a JP Morgan-style framework actually differ from, say, Heraeus or ANZ? Are they all just Fed cuts and war risk, or is there real nuance under the surface?
Good push. JP Morgan leans heavily on macro and flows. Their type of model often ties a price path to expected cuts, real yields, and ETF inflows. Something like, if the Fed delivers a certain number of cuts and real yields drop by a set amount, then ETF demand climbs, and that justifies a move towards those targets.
So that's very rates-driven. Does that make sense?
Exactly. A Heraeus-style outlook tends to be more physical. They look closely at jewelry demand, industrial use, and mine supply, along with central bank buying. If they project tighter supply relative to demand, they're more comfortable with higher price ranges.
And here's what an investor needs to grasp. A rates-driven framework is fragile if inflation falls faster than expected or if the Fed stays hawkish. A physical-driven framework can crack if recession crushes jewelry and technology demand.
Which is why listeners should stay a bit skeptical of single numbers. The useful question is, what has to go right for this forecast? Do we really get a friendly inflation path, clean Fed cuts, no deep recession, and ongoing central bank buying, all in one package?
And meanwhile, traders live in the week-to-week noise. A stronger jobs report hits, yields jump, the dollar rips higher, and both gold and silver suddenly feel heavy, even while those 5,000-plus targets sit on a slide deck somewhere.
For short-term traders, that volatility is the whole game. Intraday swings around data, stop-loss runs, margin calls, that is where risk and opportunity live.
For long-term allocators, the question is fundamentally different. They're asking whether these pullbacks are just noise inside a multi-year uptrend driven by policy, debt, and geopolitical stress.
Related to this is the safe haven story. If gold is supposed to like crisis, why did we see it sell off when war headlines started hitting and strong jobs data showed up at the same time?
And if those moments can actually knock gold down instead of sending it higher, what does safe haven really mean in practice for someone buying today?
Shifting gears a bit, I want to walk through how the Iran conflict actually showed up in gold prices, step by step. Because the headlines said war, but the tape told a stranger story.
Right. Let's think about that sequence because a lot of listeners probably expected a straight line higher.
So when the fighting first escalated, we saw a sharp sell-off in gold. Reuters and CNBC both framed it as a safe haven shock, yet prices dropped as traders rushed for dollars and raised cash in a hurry.
So here's what's interesting. On day one of war, gold was acting more like a source of liquidity than a shield. That feels backwards.
Exactly. Then, over the following weeks, as the conflict dragged on, we had what several outlets called the worst monthly performance since the global financial crisis. Only later did we see the rebound, with stories on Yahoo Finance and Investing.com talking about potential new highs as demand reset.
So investors got hit 3 times. Initial drop, bad month, then a recovery they had to chase. Here's my real question. Why does gold fall right when the scary news hits?
The important thing to understand is that war headlines are only one input. In those first days, the dollar jumped, real yields pushed higher, and a lot of leveraged traders faced margin calls on stocks and other trades.
So they sold what they could sell, not what they really wanted to let go of.
Exactly. Gold is liquid, so it becomes the ATM. Funds dump it to raise cash, which pushes the price down, even though on paper, risk is rising.
That explains the first leg. But then why did the narrative flip from worst month since the crisis to maybe new highs ahead as the same war kept grinding on?
Once the forced selling and margin pressure eased, more strategic buyers stepped in. You had investors looking at the same conflict, plus worries about policy drift, and saying, at these lower levels, I want more protection. That second wave is where the safe haven story starts to look more familiar.
So safe haven behavior showed up, but with a delay. The important thing to understand is, first, gold suffers from the plumbing of markets, then the macro buyers arrive.
That is a good way to put it.
Now, let's consider the macro data. Around the same time, we had very strong U.S. jobs numbers and markets dialing back expectations for early or aggressive rate cuts. How did that collide with the war story?
Strong jobs data reinforced the idea that the Federal Reserve could keep short-term rates higher for longer. That pushed real yields up and supported the dollar, both of which usually pressure bullion.
So you had this fundamental tension. War risk arguing for more gold, yields and the dollar arguing against it.
And on top of that, some big banks still publish notes arguing that, between conflict risk and eventual policy shifts, gold could jump 30 to 35% by mid-year from where it had been trading.
Which reveals a huge gap between the lived experience of my gold just dropped on war headlines and the forecast world of this might still surge. So how should listeners actually think about the safe haven label in light of all that?
I think you have to separate time horizons. In the first 48 hours of a shock, gold might act like a funding source. Over months, as the war reshapes inflation expectations, growth fears, and central bank behavior, the protective role tends to show up more clearly.
So if you're thinking, war breaks out, price goes straight up tomorrow, that's the wrong mental model.
Exactly. Safe haven does not guarantee intraday gains on every scary headline. It describes how gold behaves across a full crisis cycle, from panic selling to policy response to longer-term repositioning.
And that leads us to a hard question. If gold can drop on the day of a war, can we still call it a safe haven without confusing people?
I would say yes, with a disclaimer. You need a wide enough time frame, and you have to remember that safe haven demand competes with forces like yields, dollar strength, and leverage unwinds.
So this leads us straight to the next piece. If war and jobs data are pushing prices around like this, who is actually buying and selling through the noise? Central banks, ETFs, or fast money?
Exactly where we should go next, because once you see which hands are steady and which are jittery, the whole safe haven story looks very different. With that in mind, let's think about this. How do we square headlines about central banks selling gold in February with data that still shows them as net buyers?
Right. This is where headlines versus totals can mislead you. A few high-profile sales hit MarketWatch and Kitco, but when you add up all the central banks, the groups still increased their holdings. Think of it like one big fund trimming while 10 smaller funds keep adding.
So the real story is not central banks are dumping gold, it's some are rebalancing while others quietly keep stacking, right?
Exactly. And the ones still accumulating tend to be emerging markets that want less dollar exposure over the long run. That slow, steady buying says they still see gold as strategic reserve insurance, even if a few peers take profits after a big run.
Here's the thing, though. If big official players are net buyers, why did prices sag through February?
Because price is set at the margin. On one side, you have that long horizon central bank demand. On the other, you had a stronger dollar index and higher treasury yields, which Kitco highlighted. That combination pressured futures traders and ETFs day to day.
So walk me through the ETF angle. When yields pop and dollar jumps, what actually happens inside products like GLD?
When yields pop, holding cash or bonds looks more attractive, so some investors redeem GLD shares to rotate into higher income. You see daily outflows, which force the trust to sell a little bullion, adding short-term pressure even while central banks are buying in the background.
Think about it this way. Central banks act like the slow tide. ETFs are the waves slapping the shore. You feel the waves in your portfolio even if the tide is still coming in. That is a great image. And you can see the flip side, too. When yields ease or the dollar softens, those ETF flows can swing back fast, creating a sharp rally without any dramatic change in central bank behavior.
Now let's consider the flip side and bring in silver, because silver ETFs look twitchier to me than gold.
They are. Take GLD compared with a silver miners ETF like SIL. GLD holds physical gold, so it usually moves roughly 1-for-1 with the metal, with an expense ratio of around 40 basis points and smaller daily swings.
While SIL owns mining stocks, which are basically a leveraged bet on silver prices plus company risk. So on a rough day for silver, SIL might drop twice as much as the metal itself. That's the real tension.
Exactly. Over a year, that often shows up as much larger drawdowns. Where GLD might have a peak-to-trough slide in the teens during a rough patch, SIL can see declines that look more like aggressive tech stocks.
So here's why this matters. GLD is a tool for getting metal exposure with relatively smoother volatility, while SIL is a higher octane way to express a view on silver with real downside if you mistime it.
Right. And that feeds into how listeners translate flows into action. If you want to follow the central banks, you focus on that slow accumulation idea. That usually means physical, allocated accounts, or a core GLD-style position you hold through noise, not chasing every monthly inflow number.
And if you're looking at SIL or similar funds, you treat them more like trading instruments than core reserves. Shorter holding periods, clear stop losses, and a position size that accounts for real swings.
I would add one guardrail. February's central bank data or a single week of ETF flows is a snapshot, not a script. Do not rewire your whole strategy because one country sold or because GLD had a few days of outflows.
Right. Look for patterns across quarters, not just one print. And always match the vehicle to your goal. Long horizon inflation hedge, that leans you towards gold and steadier products. Tactical silver bet? Then a miners ETF might be appropriate if you're willing to accept the ride.
This leads us to the people supplying that metal. Coming up, we'll shift to the mine side and talk about how streaming deals and big moves by names like BHP and Wheaton shape the future supply picture that all these central banks and ETFs are ultimately fighting over. Shifting gears quickly, I want to start on the mine side with a basic question. What is a streaming deal?
Yes, define that, because it sounds technical, but it shows up constantly in headlines now.
Think of it like this. A miner needs cash today, a streamer gives them that cash, and in return, the streamer buys part of the future metal output at a low fixed price. It's like pre-selling some future production.
So here's what's happening. The miner offloads price risk and funding stress, and the streamer is essentially betting that metal prices will be higher down the road.
Exactly. Take that big Antamina deal between BHP and Wheaton in the US, priced around $4.3 billion. Wheaton pays up front, and in exchange, it gets a slice of the mine's silver production for decades at a contract price far below market.
Curious, which raises the obvious question, what must Wheaton actually think about long-term silver prices if they're willing to wire $4.3 billion today?
The important thing to understand is that a streamer like Wheaton is not aiming for a tiny edge. They want a wide gap between the fixed cost they pay per ounce and the silver price they expect over the life of that mine.
Right, and when you stack that beside their Jervois project streams, roughly $275 million, you see a pattern. They're building a silver pipeline that only makes sense if they believe the 2030s will reward that risk.
And not just price, but time. These contracts often run 15, 20, even 25 years. That connects directly to what we said earlier about long-term forecasts. Miners and streamers are making those forecasts with real money.
So here's why this matters. Today's streaming deals are like a direct poll of what sophisticated capital really thinks about silver, and by extension, the whole precious metals stack.
Exactly. And now add something like Barrick weighing an IPO step for one of its assets. That tells you large producers still want equity capital even with higher expected metal prices.
Which sounds paradoxical. If prices are supposed to rise, why issue more stock?
Because big projects need billions in upfront capital. Higher long-term price decks make those projects look viable, but the money still has to come from somewhere. New equity is one route.
And here's the key. More equity supply can dampen individual share prices, even if the gold or silver thesis looks strong. That's where investors sometimes get blindsided.
Exactly. So you have this mix. Streamers writing huge checks, majors considering IPOs, all based on long-dated expectations that do not care about a rough week or month.
And that brings us back to strategy. For a retail investor, how do you actually use this information?
I would say start with 3 practical watches. First, in streaming names, track new deals and their assumed metal prices. If a streamer suddenly slows its deal flow, that can signal more caution on long-term prices.
Second, watch how producers raise capital. Are they selling equity, issuing debt, or farming out streams and royalties? Each choice tells you how confident they feel and how risk is being shared.
And third, connect that to metal diversification. If streamers are leaning into silver while platinum and palladium deals stay quiet, that shapes how you might size those smaller positions.
So for sizing in a volatile 2026, let's think about this. Core gold exposure at the center, a smaller ring of silver, and then even smaller slices for platinum and palladium if you use them at all.
I agree, and I would stress that miners and streamers, because of their equity risk, usually sit on the outer ring of that ladder. You do not fund your emergency savings with junior miners.
Exactly. Think of miners and streaming stocks as higher-octane expressions of a metals view, not as replacements for basic bullion or low-cost ETFs.
And as you hear about new deals this year, ask one question. What is the long-term price story these companies are quietly telling with their capital?
Because those contracts and IPO filings will still be shaping the metals supply picture long after this week's chart has faded from memory.
To put this in perspective, if you remember our safe haven stress test from earlier, gold acting like an ATM in the panic phase is exactly why disciplined sizing and time horizons matter.
And that's the core takeaway. Gold still protects wealth, but only if you respect liquidity shocks and avoid betting the house on a single headline.
Exactly. If this gold discussion helped you see past the noise, subscribe, leave a quick review, and share this episode with a friend who watches the tape a little too closely.
So if you have questions, topic requests, or want us to break down a specific position, email us at goldstandard@heymato.com.
We also have more on streaming deals and miner strategy coming up, so stay tuned for that.
Thanks for spending your time with us today.
This is the Gold Standard, signing off.
And we'll see you in the next episode.